Peter Rose, Longwood Currency Trading. It's a wonderful November day in New England in 2021. Forex traders, watch your top knot. What the heck does that mean? The introduction that I had to the phrase "watch your top knot" was Will Geer's character Bear Claw Chris Lapp's advice to Jeremiah Johnson in the marvelous 1972 movie Jeremiah Johnson, starring Robert Redford. A top knot is the last diamond hitch that's tied to secure a pack of supplies onto a mule or a horse. And if the rider doesn't get that knot tied correctly, there's a strong chance that they're going to lose their supplies. In Forex, that top knot is your stop. If you don't put your stop in the right place, if you don't get that set correctly, then there's a strong chance you lose most of your money over the long run. Sometimes in the short term, you can fade the system and you'll come out okay. But over the long run, if you get that top knot wrong, if you get that stop wrong, it's going to go badly for you. But before I continue on with this, the guys are here doing the fall cleanup, and they are just wanting me to check out how they've cleared out the brook and done some other stuff. It's a really chilly mid-November day in 2021, so I'm going to go out and I'll take you along with me, and we'll go see the landscaping job that they're working on. And so I'll be back with you in a minute to talk about watch your top knot. As I said, I take you on a tour of this work process that we have going on today. Actually, we've got the wood rack ready to go for the wood stove. Loaded that in, several wheelbarrows full the other day. But I'm going to take you out and show you the brook. Doing the final grass cut of the season and getting all the leaves up. And here's the brook. I brought you back here several times to show you the brook, but you can't see the brook because it was all overgrown. So we've got all that squared away, and we've been listening to it for the last few days because of the rains that we've been having. And let's see what's going on back there. There you go. Yeah, they got all this cleaned out. This wasn't running anywhere near that well earlier because of all the leaves and stuff that was trapped in there. So that makes it really nice. See the wood piles over there behind the... We'll go over there and take a look at all that. Looks like a lot of leaves. A lot of leaves. You want to be on a YouTube video?
Yeah. All RJ Michi Landscaping.
There you go. Like they said in the movie Jaws, you need a bigger boat, you might need a bigger truck.
Yeah. I don't know how much bigger they make these things. For a 10-wheeler.
Yeah, right.
For the tri-axle.
So wave hi to all the currency traders in the world. All right. Man, it's chilly out today. I got a couple of token pumpkins. And back around the side of the house, and as you can see in the distance, the leaves are down. We are officially in stick season. Well, that's probably a longer tour, a day in the life of, than you want to see for right now. Well, I hope you enjoyed the little tour. Come on back inside. And there's the boat, Bo. Say hi to your fans. The Bo dog is upset because he can't go out and play with everybody. So let's talk about the top knot. Watching your top knot. Okay, about this watching your top knot and not getting your stop right. What does that mean? What does it mean to not get your stop right? I mean, it's as simple as saying, I'm going to get out. If the trade goes against me, I'm going to get out. But now you're in a decision process, right? You're saying, based on the conditions that I thought was going to happen, because that's why I entered a trade, now things are changing a little bit because it's going against me or it's not doing what I thought it was going to do, and so therefore how much do I want to let it go against me, and blah, 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 blah. You can resolve all that by saying, say as a day trader, I'm going to set a 20 pip stop. I'm going to give price room to breathe. Or you can do it like I do. If I go, and again, I'm on a 5-minute chart with a 5-period ATR, so I set an 8 pip stop. That's an ATR and a half. If I was trading on a 100 pip ATR, I'm not going to set a 150 pip stop. You know, so it's not translatable in that sense. It's just that for the profit gain that I'm looking for on a daily basis, which is, you know, 10 to 20 pips, I don't see why I should be taking a 20 pip risk. If the price starts moving against me, what's it going to move? It's going to move 8 pips, 10 pips, 12 pips, 15? It's going to turn around 15 and go back in my direction? I think if it gets to that 8 pip point, it's not going to go in my direction. So take the 8 pip loss. It'll go down to 12, and then it'll turn around and it'll come back. And you can say, well, geez, you know, you lost 8 pips, the thing turned around to 15. If you'd had a 20 pip stop, you wouldn't have get stopped out, and you'd have had that trade. It would have been a profitable trade. Well, how often is it going to go and is it going to hit the 20 pip stop? Make it 30 pips, make it 100 pips, don't fucking make any difference. The longer you put that stop out, the more dollars you're going to lose. You have to differentiate between trading by pips and trading by dollars. You trade by pips and profit, but you've got to take your risk as a factor of dollars. You know, look, if you're trading a 10 lot, it's an $800 loss at 8 pips. But at 20 pips, you see what I'm saying? You have to be very careful, particularly as a day trader, in watching that top knot. I believe that even with a minimal win-to-loss ratio, and I've done this mathematically, and it's on some of the videos that I've done before, is that even if you're minimally successful with a low win-to-loss ratio, if you nip that loss right away at 8 pips, and you could use the 8 pips as an example all the time. Your situation may be totally different, but the percentage-wise factors are going to be relatively the same. If I'm a 60-40 trader, so I lose 8 pips 4 times and I win 10. Let's see, if I lose, it's 32. If I win 6 trades, 60 pips, you know, I'm good. I take the 30 off or the 40 off, and I'm 20 pips ahead. Now, is 20 pips enough over 10 trades to win? That's two pips win per trade that you make, and that's a relatively poor, what you would call an expected per trade profit. 2 pips. Every time you step up to the table, you pull 2 pips. 2 pips 1,000 is I mean, it's not much, right? So you have to really ask yourself, are you going to trade enough times that that 2 pips, 0.2% gain, will add up to a sufficient number of dollars with a low bank, and add up to a sufficient number of dollars for a large bank, like if you're trading a 5 or a 10 full lot in 5 or 10 full lot positions, and then each pip becomes worth. If you're trading a 10 pip, if you're trading 10 lots, then each pip's worth $100, right? So the two pips now becomes $200. That's a pretty good daily wage that you could pay yourself. But you're going to have $100,000 to do that. So obviously, if you're trading a mini lot, you're making $2 a day, and you have to be willing to do that to get your process down, so that when you do have a $50,000 or $100,000 account, then those 2 pips become significant. But it's not going to be 2 pips when you become consistent with your trading. Your trade entry process and information becomes so much more viable that you go from a 60-40 trader to 70-30. And the same pip loss and pip gain average that you have translates into some really significant money, very nice money, even at the 60-40 level. And again, you could do those calculations on your own and prove that out for yourself. The thrust of the thing is, you can't try to make a lot of money from a little money. You only make a lot of money from a lot of money. If you have a little amount of money and you're trying to make a lot of money from it, you're taking more risk than probably your skill level will enable you to do. And why do that? Why not hone your craft? So if the best you can do is an average of 5 pips a day, that's $5 a thousand. So if you trade a $100,000 account, you're $500. You're $100 times 5. You're making $500 a day. That's $100,000 a year. And they say, well, that's just an extraordinarily large amount of money to make on 5 pips. It's doubling your count in a year. Well, yeah, but it's only 5 pips. If you were trying to get 20 pips a day to make the same $500 on a lesser amount of bank, you're taking way, way, way too much risk. And you're trying to shoot for 20 pips a day. How are you going to get 20 pips a day? You don't want to trade 50 times a day with a large account, because you're just going to get yourself jacked up. If you want to trade a lot, you trade a lot with a small amount of money to build up those small gains. If your average is 2 pips a trade, then you want to trade 15 times a day or 20 times a day, and you're just knocking off those low-hanging fruit. You can do that, but you're not going to trade 30 times a day and make 20 pips each time. It's not going to do it. You are increasing the likelihood that you're going to run into a series of losses, and you're going to get cranked. So watch your top knot, because setting that stop is so critical in developing the discipline to set that stop. You've got to do the mathematics. If I have a student, I'll work with them. I'll do that mathematics. This is what you need to do in order to achieve your particular goals. And this is the safe way to go about doing that. Now, whether you got the discipline to do that or not, I don't know. But I'm just here to tell you from a mathematical standpoint that you're most likely in that 60-40 win-loss ratio starting out, if you're not even less than that. You can still make money as a 30% winner, but your profit amount of profits you're going to have to make when you do win, those 3 times out of 10, is going to have to be really big, even with an 8 pip stop. 7 times 8 is got to be far less than than 3 times whatever number you're going to need to make when you win, right? So few people have that discipline. I'm a very disciplined person, but trying to get 20 or 30 pips on a trade, you know, you're there a long time, and you got to really do the work, or you got to trade multiple times a day. Over time, you learn how to overcome some of those problems, but you don't learn good trading habits if you can't trade with a small amount of money to develop a good win-to-loss ratio. You got to get the good win-to-loss ratio, and once you have that, back up the truck and fill up your account and trade for the big numbers, because the percentages then should still be valid unless hope, fear, and greed get in your way and you say, well, you know, I'm going to let this price breathe, and instead of this short stop, I'm going to take it out a little bit longer, and instead of just trying for 5 pips a day or 8 pips a day as a winner or whatever, I'm going to shoot for 20 pips a day. You're screwed. I'm just telling you, you're screwed. The banks don't trade that way. They trade for a totally different reason, but they make money. So you should learn the difference between trading for shits and grins and trading to make money. If all you want to do is entertain yourself, you do whatever you want to do. This is probably not the channel for you to watch. And I'm certainly not the guy to take advice from as to how you should conduct your trading life. Watch your top knot. Set your stop right and be consistent with the stop. If you can be consistent with the stop and you are failing in your trading, it simply means if the stop's not too tight, it's that you need to improve your trade entry analysis. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.